Hello everyone, Trader welcomes you all. A lot of traders face this challenge of trading Nifty futures or options. Today I bring you a strategy which I call as my strategy number 7, which is the open high low close based strategy. And today we'll be discussing the bearish patterns on this strategy. This strategy focuses on the open, the high, the low and the closing price of previous day. So first we'll go through the rules of this particular strategy before we look into the bearish patterns, and then we'll move to the patterns that we'll have to look for before we take the trade for the day. And this strategy is applicable for intraday traders, traders who are facing challenges figuring out the entry and exits in Nifty futures or options. So rule number 1. We'll look at the previous day candle. Now, what sort of candle are we looking for? So we will be looking for, since we'll be discussing bearish entries today, we'll be looking for bearish candles. So this is one of the bearish candle. This would be a bearish candle. This would be a bearish candle. So all these red candles will be considered as bearish candles. This is also a bearish candle. Now we'll be avoiding candles which are very small in size. This kind of candles we'll be avoiding because it doesn't really, the color doesn't really signify anything. This is kind of a indecision. This here is kind of a pause. So we don't know whether the momentum is going to continue or it's going to reverse. So we'll be avoiding entries after this kind of candle if the opening is within the range of such indecision candles. So we'll be avoiding those entries. So that is the rule number 1. We'll look for a very strong bearish candle. Now, rule number 2, the opening of the current day should be within the range of the previous day. So that is the rule number 2. So for example, if we are looking for this particular candle, if we are planning to trade on this particular day, now even though the trend is kind of bullish here, but since this particular candle is bearish and on this particular day we are planning to trade, the market has opened here, which means it has opened within the range. And before you think, guys, that this is a range breakout strategy, this is not. So this is completely a different strategy, and as we discuss the strategy ahead, you will understand why it is a different strategy. So here the market has opened here, which is well within the range of the previous day. Now, what are we going to look at? This is our second criterion. Now, once the market has opened, our view is going to be as per the previous day's sentiment. So in this case, today we are discussing bearish entries. So yesterday, which means the previous day, on this particular day, the candle was a solid red with a little bit of a wick on both ends. So we are going to consider today's entry as so today we'll have a bearish sentiment, and we are going to look for reasons to enter a bearish position. Very important, guys. We'll be looking for reasons to enter a bearish trade. So it doesn't mean that if the previous day is bearish, we'll just hop into a bearish position as soon as the market opens. No, we'll have to wait for the price action. Now here lies the bigger challenge. What sort of price action are we looking for? How do we decide whether to enter or not? So that is where we'll go ahead and start our presentation, and we'll see what sort of price actions are we looking for. And I have classified the price actions. So one by one, we'll be discussing each price action. So let's go ahead and start the presentation. Any of you want this PPT, guys, please write in the comment section and I'll go ahead and share it with you. So the first price action that we'll be looking for is any sort of continuation pattern from the previous day. So remember, we are discussing the bearish patterns here. So on the current day, any entry that we decide is going to be in the favor of a bearish pattern. So here, what kind of continuation are we looking for? So in this case, since the market on the previous day has closed bearish, if the market is opening anywhere near the lows or the closing price and is showing us signs that it's going to continue, that is where we'll go ahead and enter a bearish trade. So here, as you can see, this particular candle is a bearish candle, and then we followed by a halt candle. We are still not entering. When this particular low starts to break, that is where we enter a bearish position. And that is exactly if you see here on the 15 minutes chart. So this particular chart is a 5 minutes chart. All along the presentation, this is going to be the 5 minutes chart, and the chart on the right side is going to be the 15 minutes chart. So as you can see, it's a solid red candle formation. Instead of waiting for the 15 minutes chart to close, here itself we can see that this particular low gets broken. Low of the first two 5-minute candles low is broken, and there itself we can enter. And as you can see, it has gone down significantly. So we are not. So exit pattern is something which you'll have to figure out, or we can discuss this on a different video. But I would suggest that if an option price has increased 10%, it's best that you start exiting. So we'll quickly go through these patterns. We'll not spend a lot of time on each pattern. Here, as you can see, this again, the previous day closed here. The previous day closed here, and the low was here, and the very first 5-minute candle has broken it. It's a very clean breakout. As soon as it starts to break, we can enter. If you want to wait, then it becomes a really big candle. Then you have to wait a little further. You have to hold on before this pause situation breaks down, and then you can enter having stop loss somewhere here. Same thing here, guys. As you can see, this is your closing price of previous day, and this is your low, and there is a very clean breakout which is happening, breakdown which is happening, and you can enter right after it starts to break, or you can enter at the close of the candle having a stop loss somewhere here. So for those of you who are worrying with a very, you're worrying about the huge stop loss, let me tell you, if the stop loss appears huge, then try to at least reduce your position sizes. Whatever position you take, at least take 1/4 of that position size. So that is the trick. Otherwise, you're going to miss out on a lot of good momentum in the morning. Same pattern here, guys. As you can see, let me tell you how you can enter this. So this was the closing price. This was the swing low. As you can see, this was the swing low of the previous day. And this was the closing price. And this was the lowest low of that day. Now, as soon as this particular candle closes, you can either enter. If you're not confident that, it can take support here, then you can wait. As you can see here, after this particular consolidation, it got reversed and it came and hit the swing low of the previous day, or you can say the closing price area. Now, a very important thing that we'll see, a lot of patterns that we are going to discuss. Here, as you can see, there is one engulfing candle. Here is one engulfing candle. So these are going to be indicators of your entry. And like we know, none of that strategy that we talk about or any trader talks about is 100% guaranteed strategy. And similarly, here also, as you can see, though this particular area gives you a very good conviction of entry, and as you can see, there are a lot of people who would have entered here. Their stop losses got here hit. And see, the point is that previous days closing prices are a very good entry points, and this zone is the previous day's closing price. Anybody who entered after this particular engulfing candle made good decent amount of money. So we'll go through the slides very, very quickly. Here also we see that the previous day's lows are very cleanly broken. In this example as well, the previous day's lows are very neatly broken, followed by a very good downfall. Here as well, as you can see, we'll quickly discuss this. So the market opened here. Exactly, market opened flat, and this was the low of previous day. It broke. Now it's a very big candle. Anybody who entered here is going to have a very huge stop loss, and if your position sizing is low, you're not going to be scared if the market comes down to this level. Otherwise, people who are not confident about entering, wait for the candle to form some sort of retracement back to this zone, and when this particular candle forms, that is the indication that it's taking rejection again from the previous day's lows, and that is where you can enter. If you look at the 15 minutes candle, the candle has closed below the previous day's lows, which means this particular zone, 17,175, is a very good entry point. And that is exactly where we are going to enter, which is here. These are a few examples, same examples of continuation from the previous day. As you can see, clean breakdowns from previous days. Here, this example needs a little bit of explanation. So even though this particular candle is a huge one, anybody who enters is going to have a very, very huge stop loss. somebody who is waiting for some sort of consolidation, what you can do is, once these two candles are formed, as you can see, this is an engulfing candle. It is engulfing the previous green candle, which means whatever gains this candle gave, it wiped off immediately, which means the selling or the sellers have jumped in this zone, and you can enter at this particular level having your stop losses here. And of course, as soon as by this particular zone, your options will definitely have gained at least 10%. If it is at the money options, then by this level you will have gained at least 10% of the value. So you can exit by here without waiting for a green candle. This is also an example. Now, before we discuss all continuation patterns, we'll go ahead to the next bearish. The next bearish pattern will be when the market opens near the previous day's swing. So in the previous day, any swing which was created, a swing high or swing low, if the market opens near to that, and if the market goes and hits that particular swing area, then what is the price action that we are going to look for? So as you can see, I have marked here the rejections are continuously coming from these particular swing area. Anybody who entered in the very first attempt, obviously they are going to be scared when it comes back here. But anybody who is entering here will probably have to have a decent stop loss above the previous swing highs. So it is better to wait for another retracement. If you enter here, or if you enter after this engulfing, then you have a very decent stop loss. Of course, you cannot predict. The best way is to wait. If there is a sideways price action, just wait for the market to show you some sort of sign. And that sign definitely has come after this particular candle. If you look at the 15 minutes chart, the market opened here, it came down, it went up, it kind of halted in this zone, and then on this particular candle, you can see in the 15 minutes candle has closed below the body of both of these two candles. These two candles body, it has closed below it. So it gives a very good entry point here with your stop losses here. So similarly, if we discuss a few more. So this is also a very good price action. As you can see, there is a bearish solid candle on 5 minutes chart formed exactly at the swing high of previous day. And then there is some sort of consolidation here, and then the consolidation starts to break. That is exactly where you can enter. You can also enter directly here after the first 5 minutes of candle, because if you see on the 15 minutes chart, it is exactly taking resistance from the previous swing high. So that again is a very good entry. These are some of the examples. So trend lines. A lot of people must have tried the trend line strategy and would have failed miserably. One of the reasons is because everybody, even the big players, know that people are looking at the trend line, and the problem with all of us traders trading the trend line is that we often try to trade the breakdown of the trend line rather than trading the support from the trend lines. And that is what is the biggest mistake, or I would say flaw in new traders. Because if you can see, this particular point and this particular point has formed this particular trend line, and everybody would have jumped to sell after this candle closed a little bit below this. And that is exactly what happens. We all want to trade the breakdown because we want to catch the first train towards reversal, and that seldom happens. So after you have waited this particular hit, this is the first hit, this particular point is the second hit, this particular point is the third hit, this somewhat is the fourth hit, and then this is the fifth hit. And here, when you have a solid closing below the trend line on a 5 minutes chart, that is going to be the best entry. And this is exactly how we need to trade the trend line, guys. You have to wait for multiple support from the trend line. Only then, if it breaks, that is where we enter, because this particular breakdown coincides with the breakdown of the 15 minutes on the 15 minutes chart as well. And that is why this is a very good trend line breakdown. Let's see this example also. These 2 points has formed this particular support trend line, and then we see this particular point, which is the first hit after the trend line formation. This is the second hit. This downward move can be considered as a third hit, and then this fourth attempt is breaking down. So very good. As you can see on the 15 minutes also, there is a very solid breakdown candle, and you can enter there also. Here as well, you can see exactly same. Now the next and very important price action pattern that we are going to discuss, and this we'll be discussing in a little bit detail because this is one of the most successful and working price actions that will work with this OHLC strategy number 7 of TraderVeda. So let me tell you what it is. This is the bearish engulfing candles. So the bearish engulfing, when we talk about bearish engulfing, we are going to mean that any candle that reverses the gain of the previous candle entirely. Any candle that proves the previous green candle was just a hoax or just a trap, we are going to consider those candles as engulfing candles. Now, on this particular example, as you can see here, slowly and gradually it was rising to the swing highs of the previous day, previous immediate swing that we see from the opening price. And then we see these two candles, both are hammers, hence we'll ignore, and then this particular candle is a solid candle which is showing that it's going to go down. Now a lot of you would not be able to trust 5-minute candles, so if you want to see the 15 minutes candle, here is it. As you can see, this particular green candle, a lot of people thought, okay, it's taking support, it's going to break. But then if you wait enough, you will see that this particular, in the next 15 minutes, it has wiped off the gain. And even if you enter here, even if you have a big stop loss, you are going to gain at least 1:1. Next example, very good example. Market closed here. Other day, the market, the current day market opened here. This is the previous day low. It took support. It's coming up. Now here, this particular candle, you can see this particular red candle has wiped off entirely this particular green candles. And we have to have, and why are we, talking of selling here and not buying here? A lot of people will ask. The reason is yesterday's or the previous day's candle was bearish candle, and as per our trade logic, if the yesterday was a bearish day, today we are going to look for bearish patterns, and that is exactly what we are doing. If you talk about this particular candle, it has not entirely closed, and we see that here there is a huge support formation. That is why we don't enter here. We are waiting a little bit, and then we see that here we see that kind of activity. Now if you are not confident entering here, and if you want to look at the 15-minute candle, and here you can see this particular candle has completely wiped off this particular gain, and it has broken yesterday's low and closed below the low, which further confirms the bearishness, and you can enter right here. So another very beautiful example we'll see. Market opened here. It started to come down, started to form some sort of support. It was a gap down. So we are waiting for the gap to fill, hence it is coming up. This is the previous day's close price. This particular candle has entirely engulfed this smaller candle. So people who are risk takers can enter here. Otherwise, if you want to be on a safer side and look for the 15 minutes confirmation, then this particular 15-minute candle's gain is wiped off by this particular 15-minute candle's fall. It's a very solid candle, as you can see, and you can enter here. Very easily you can enter here and target these particular levels. So this is how you plan to enter, guys. I mean, if you're planning to enter a bearish trade, and the previous day is bearish, and today's price action, let's say it started with a bullish price action, it has come to the previous day's closing or open or high, any of those price levels. So previous day's open, high, low or close is going to be very important price levels. And in this case, if the price is coming from below and it's coming towards previous day's opening price, just think, people who sold yesterday, big players who sold yesterday and managed to close the day in red. So yesterday's closing price is going to be a very attractive closing price for, very attractive selling price for today also. And that is why, as you can see here, from the yesterday's open and high zone, there is a fall. How do we judge where to enter? We'll look for bearish candles. For example, this particular bearish candle is a very good candle to enter on 5 minutes. This candle is also a very good candle to enter. If you look at the 15 minutes candle, you can enter on this candle, but here a lot of people will think that, okay, there is going to be a swing there is going to be a retracement. So you can avoid this candle and you can enter on this particular candle. Once there is a confirmation that the bearishness is back, you can enter here. Here also, if we see, this is the previous day's low, this line is previous day low, and this is the previous day close. Here is the previous day close, this is the previous day low. The market forms a very big candle, so we wait for some sort of consolidation. It tries to come back up, and then here it forms a base and it starts to break here. If you look at the 15 minutes candle, you will see that this particular candle is a confirmation of a swing. As you can see, it came down, came up, it's coming down. So this is a bearish pattern in the making. So you can enter after this particular candle also. So similarly, there are a lot of price actions here also. As you can see, I've pointed a bearish engulfing candle. Here also, as you can see, you can pause and you can see the bearish engulfing candles. So the point I'm trying to make, guys, you can pause and you can see these patterns which I have marked. And if you want the PPT, I can share with you. So bearish engulfing is a very important price action which you can use to enter a bearish trade when the previous day closed bearishly. The next price action that we have on this particular presentation is double top formation. So this is also one of the very important formations that you can look for. So any of you need further explanation to this strategy? If you have any questions, do let us know. We'll go ahead and answer all your queries. And any of you need the PPT, do let us know in the comment section. It's free. So the next video will be discussing the bullish patterns and how we can enter a bullish trade after a bullish day. See you in the next video.